Welcome to Market Domination. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
I would say totally solidifies a 25 basis point cut. I don't think we were ever really in the 50 basis point camp. This would be the fifth decent report in a row for the Fed, giving them the comfort and the confidence to cut again or to start cutting. And I think 25 basis points is a good place to start.
What Goldman Sachs has said is that Donald Trump's plan would make the economy worse. Mine would strengthen the economy.
It's just hard to see that debate as anything else but an overwhelming victory for her. And again, I don't think that's an odd view, a dissenting view. I think it's the overwhelming view this morning among Republicans and Democrats who watch that debate.
Well, we're going to see a floor at some point here, but I'm not so sure it's now. Oil is a problem. This has been a very, very bad week for all the oil analysts, for companies or countries that are in OPEC, and for all of the entities that try to measure the temperature of crude.
We've got 1 hour to go until the market close, so let's take a look at the major averages here. We have been seeing an improving trajectory today.
Yeah.
The Dow right now is down by about 19 points. It briefly went into the green right over here and then dipped back down, but really call it unchanged right now. The S&P 500 more solidly in the green, up about 0.5%, shifted over, call it an hour ago or so. And the Nasdaq, which has been the leader of the day, up 1.4% and has been green for longer, as well as having that bigger magnitude of gains. Now, remember this morning, of course, we got the CPI number. And as you and I talked about, most of economists and the market's focus has shifted to labor. But nonetheless, this morning's number did seem to solidify the view that it's going to be 25 basis points, not 50 basis points.
Yeah, you got the CPI report. Was interesting, Julie, is that data was about in line.
Yeah.
But of course, the focus was on the pickup in the core index, and we did really, we had a sell-off late this morning. You do wonder, was that investors kind of thinking through, well, it doesn't mean the Fed's not cutting next week, but does it? Of course, there was some talk of a more supersized cut of 50. Did that kind of dim hopes for that? But bouncing back now.
Yeah, bouncing back now, seeming to sort of shake that off. Also, in terms of what we've been watching, of course, the debate last night and sort of what's happened as a result of that, the so-called Trump trade or Harris trade that we continue to track. One of the ways we track it is in election markets themselves. There are several ways now for investors to sort of bet on, invest in, whatever, trade on, however you want to put it. This is just over the past 3 days here, and this is on Polymarket. There are a number of predicted is another one. So the Trump victory is here in purple, and you see, while the debate was going on, a lot of bouncing around. Harris victory, odds of that, kind of bouncing around as well. Right now, at this moment, it's really neck and neck. Trump slightly edging out Harris.
It's a toss-up.
But, it's a toss-up. And as I say, on other markets like Predict It, Harris is more comfortably in the lead. These do not have predictive power necessarily, but they are a measure of sentiment by market participants that then can sort of feed back into other assets. We've been watching DJT, for example, as another way of measuring that. And we've been watching Bitcoin as well.
Yeah, it's just, a lot of notes today about different sectors and responses and reactions. Of course, as we talk a lot about today, Julie, for a lot of their policies, listening to these candidates, they would need Congress to be on board as well. And of course, the composition of Congress still, hotly debated too.
Yeah, that's on the bigger issues.
Yeah.
But then you got this, right?
Yeah.
DJT, Trump Media and Technology down 12% because this is sort of a more close proxy in the eyes of investors for his election
Bitcoin
chances.
is another fun one to watch.
Bitcoin is another fun one to watch that I mentioned as well, because at least the perception is, again, it's all about perception. The perception is that Trump is friendlier to Bitcoin. He's been more outspoken about it. It's actually recovered a little bit too with the rest of the market, because you could argue it trades more in line with tech, which we're also, of course, seeing rally in today's session. That's really the group that has been the differentiator
Nice
as we
pop
go
by
on.
Nvidia.
Here's the semis, but if you look at the Nasdaq 100, you see a lot of broad green there.
Well, Nvidia was interesting, of course. CEO Jensen Huang speaking today at a conference and making some news, talked about, demand is frankly so hot that he has customers, he says, who are a bit, his words, emotional.
Yeah.
I don't think he was criticizing them. He says, we get it, but they're knocking hard on his door for those products on hot demand. And of course, his customers were often talking about those big cloud customers, the Microsofts, the Metas.
Yeah, we're going to talk much more about Nvidia a little bit later on, but you just get a sense of what we're seeing within technology here. Here's today the XLK, the tech index, a tech group up 2.4%.
Nice pop. All right, for more, stocks today bouncing back after that morning sell-off. August hotter than expected core CPI reading dampened Wall Street's hopes for a supersized cut of 50 basis points next week. Stocks now well off the lows of the session here. And joining us now is Jason Trejo, UBS Global Wealth Management Head of Asset Allocation. Jason, it's great to see you. So big moves in the market today, Jason. We had the CPI report that hit. Late this morning, we were deep in the red, but now bouncing back. What do you make of these market moves?
Well, I don't put too much stock in one-day moves, given some of the technical factors that are driving things, and given the pullback we've had recently. You could get some short covering in certain days, things of that sort. So day to day, I don't kind of put too much stock in the moves. It's clear though, like from the inflation print, the initial reaction was, I think a lot of guests talked about earlier, that it makes 25 more likely, at least incrementally versus what we've come into the inflation print. But I think big picture doesn't really change the dynamic from the Fed perspective that, they have justification for cutting. The inflation allows them to cut. The labor market's weak enough that to me it's maybe shifting around the timing of when these cuts will happen, and more so than the magnitude in total that will actually happen this year. And I think that's ultimately really what matters for the markets overall.
Well, and it seems like the narrative in the markets has switched to the so-called bad news is bad news for the markets. But today sort of scrambled that maybe a little bit. So how, in other words, is bad economic news still negative for the stock market, even if it means the Fed isn't going to be cutting as much?
Well, it's interesting because ultimately you're kind of talking about the psychology of how investors are interpreting this data, and when do they feel confident that the Fed is not behind the curve? Are they being proactive with cuts? How pessimistic are they actually on the economy? So certainly sentiment on the economy has gotten worse in terms of confidence in a soft landing. But if the equity markets are really worried about a recession, they wouldn't be at these current levels. Credit spreads wouldn't be there. So I think the conviction in a soft landing is moderated. But yet, if they were really concerned, I think you'd see more outright selling. To me, I think the mindset of a lot of investors is they want to buy, they want to add exposure. They need economic data to sort of give them catalyst or enough evidence that the Fed is going to be sort of proactive. So whether it's a better jobs print or a dovish Fed next week, then I think either of those could sort of turn the market. But I think at the moment, I wouldn't put too much stock in whether it's bad data is bad news or vice versa. I think ultimately just investors want to see something that would give them the justification for being more confident on the overall outlook and therefore add risk.
Let me ask you, Jason, next week, let's say we do get that traditional cut, 25. How do you think the market responds? Is that baked in?
I think at this point in time, especially after the CPI data, it was already only about a 25% chance being priced in for 50 next week. It's less now. I think the key will be what does the Fed signal going forward? Given what the market pricing is, which is around or over 100 basis points for this year, there is a chance for the Fed result to be a little bit hawkish. How about that? I mean, the dot plot of the projection for rate cuts this year may only be 75. And if the market's pricing over 100, that could be interpreted as hawkish. A lot of that could kind of, though, come back to what Powell says in the press conference. If it kind of echoes Chris Waller's comments last week that, if the data weakens, they're prepared to be very aggressive. Basically, they're saying any sign of weakness, we will move to 50, and I think the markets would like that. So a lot of it comes down to the exact nuance and terms that I think really Powell says in the press conference, more so than updated dot plots. So there is scope for disappointment, but I think there's also ways in the market can interpret this as like, all right, the Fed essentially has got our back. The Fed put is very active. That's the key thing.
Jason, you heard us talking earlier about tech helping drag stocks up today. You guys are still positive on technology. Why is that after the sort of rockiness that we've been seeing there?
Well, there's a few factors why we like tech as a sector within the S&P 500 overall. One is that the earnings numbers are coming through, and we saw that, like you mentioned Nvidia earlier. the results were still impressive, but they perhaps didn't guide as upwards as much as the market has liked in the past. So the bar is just so high. It's there's easy scope for disappointment. But the earnings, whether it's for Nvidia and others, are coming through, and sort of alluded to some of the comments from the CEO today that it's almost more of they just can't match the supply and the sort of supply problems, not a demand problem. That's the critical thing, which means I think for next year, we still expect the CapEx spend for AI to actually accelerate. There's upside risk. So you couple that with earnings that are good, this upside risk to spending. And then from a portfolio perspective, these are quality companies. They have really good earnings, very good balance sheets. An environment where there's still some uncertainty about the macro, it's not bad owning these kind of companies that have really strong earnings power, really dominant positions, versus taking either a lot of cyclical risk or getting too defensive in an environment where ultimately we still think it's going to be a soft landing in a good, relatively good macro environment over the next 6 to 12 months.
Well, judging by the trade today, you are not the only one who thinks so on technology specifically. Jason, thank you so much. Appreciate it.
You're welcome.
We're just getting started here on Market Domination. Coming up, we're going to dig more deeply into that August CPI report with an economist. That's coming up on the other side. Plus, a look at some of Yahoo Finance's top trending tickers, including the ever-dominant AI darling Nvidia. And oil rebounding today from its sharp Tuesday sell-off. We'll discuss the latest price action and what it means for would-be energy investors when we return on Market Domination. The latest consumer price index print mostly in line with economists' expectations, but looking under the hood, outcomes were mixed across categories. In particular, shelter costs accelerated in August. Here helping us break down the report is Jose Torres, senior economist at Interactive Brokers. Jose, it's always good to see you. And I found the shelter component really interesting here. We saw a 0.5% increase there, an acceleration for the second straight month. I do want to talk about the big picture for CPI, but I also want to talk about shelter. Why is shelter so sticky here? And will we still see that variable lag from the hikes that the Fed has done?
Great to see you, Julie and Josh. I don't think so. I think as rates are coming down, specifically 30-year fixed mortgage rate, folks have fear of missing out. Similar to what you saw today in the stock market, we saw the S&P down 1.5%, but then folks came in and they started buying up tech stocks. That's a crucial element that's happening in the housing market. Remember, we have underbuilt conditions, we have substantial immigration, and that third FOMO element. Also, used and new cars, when you look at them combined, 8th consecutive month of declines. Right? How much longer can we count on cars continuing to decline in price? I'm expecting as the Fed begins to lower rates that pricing power at dealerships will begin to increase, and then those things will become more expensive. And maybe that's going to perhaps place a basement on how low the Fed can go.
What's the read-through, Jose, from CPI to PCE, the Fed's preferred inflation gauge?
Well, Josh, actually, shelter is weighed a lot less in PCE, maybe roughly about half. So those inflation tailwinds on CPI aren't going to show up as much on PCE.
Interesting.
And so overall, how are you feeling about the pace of inflation now? What we learned today, both with shelter and with the overall numbers?
I mean, I'm feeling great about it. I've been more of an inflation hawk in the last few years, so it's great to see CPI firmly in a two-handle, right? Not 2.9%, 2.5%, which is great. And we're seeing progress, really across the board. We just have some areas which are, problematic. Transportation services, shelter, food away from home, some of those, labor-intensive categories, dining out, those kinds of segments have been a little hotter.
JP Morgan's Jamie Dimon made some comments this week, Jose, that got some attention. Speaking at a conference, reports noting he suggested stagflation still on the table. Here's what he said, Jose. I would say the worst outcome is stagflation, recession, higher inflation. By the way, he says, I wouldn't take it off the table. What do you say to Mr. Dimon?
Well, Mr. Dimon, I think that the consumer these days, Julie and Josh, the propensity to save is particularly low. They're not out there saving to buy homes. They're not saving to buy automobiles. So what they're doing is they're spending a lot on services. Our economy is 70% services. When you look at the labor market, sure, it's been cooling. Companies aren't hiring that much, but they're also not firing either, right? So that means that the consumer is going to have a firm underpinning beneath them so that they can continue spending. So to the extent that they continue spending, you don't have stagflation because the economy will continue growing.
I want to ask, though, about the other stuff that people are spending on, too. And this came up at the debate last night, right, of course. Former President Trump talked about how much inflation has gone up. And so I was looking at some of the numbers. If you look at overall CPI, it's up 21% compared with January of 2020. Food at home, because groceries have gotten a lot of attention, up 26%. He said, I don't know, he was citing like 50%, 80% numbers. Certain things have gone up a lot. And so that psyche of the consumer who is spending more on food, how is that then feeding into their propensity to spend on other stuff?
Well, we have a bifurcated consumer, right? We have one consumer that has investment portfolios, has a couple of real estate properties. They're doing great. But the consumer that's focused more on labor income, right? Those income gains haven't really been proportionate to the gains in prices. So they've felt somewhat of a squeeze. And then also there's sticker shock, right? Us on Wall Street, yeah, sure, we see 2.5% inflation. We cheer, but other folks, they remember a bag of chips when it used to cost a quarter. Right? So that kind of sticker shock also, does, weigh on overall consumer sentiment.
You made a good point there, Jose, because we often talk about it like it's the consumer. But of course, there's different kinds of consumers. I am curious, just as an economist, though, are you seeing signs that the stress is moving up the socioeconomic ladder at all?
Yeah, it is at the margins. Remember, the bifurcated consumer, those that are doing better, they tend to be older, right? are concerned a little bit about medical care. They're concerned about their children, their grandchildren. They have a lot on their backs, right? They're also concerned about stock market bumpiness, right? We haven't made a new high in the S&P 500 since July 16th. So folks are maybe a little worried about next year's, stock market performance against the backdrop of Fed rate cut expectations, right? I think today what happened with the market and the recovery was stock bulls realized we don't want the Fed to cut in a hurry. Historically, that's been a terrible thing, right? A horizontal roll down the monetary policy stairs, a turbulent and speedy, or do you want a vertical, slow, and controlled walk down the monetary policy stairs, right? You want it to be slow and controlled, nice and easy. You don't want it to be all at once.
I love that analogy.
Yeah, very nice, Jose. Great to see you, especially on set. Good to have you.
Absolutely, absolutely. Looking to be here monthly. Thank you.
Excellent.
Thank you, Jose. Time now for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. Let's get to them. Nvidia CEO Jensen Huang starting there, lifting investors' spirits after his remarks at the Goldman Sachs Communacopia and Tech Conference. Jensen Huang highlighting the incredible demand for his products. You just stock there, around about 7%, dragging the SMH along with it. So this was an interesting, he's at the conference. He was talking here, Julie, about basically demand for his products being so red hot and so great. Everyone wants to be first, he says. Everyone wants to be most. We probably have more emotional customers today, deservedly so. It's tense. We are trying to do the best we can to get that supply to them.
Yeah, and he also talked about, he was asked about supply in particular because TSMC is their main supplier, Taiwan Semiconductor. He was asked about also potential risks to that from a geopolitical perspective. And he sort of acknowledged those risks, but that TSMC is sort of the best in class with the capability of making their chips. Just to put all of this in perspective, by the way, the stock is still up 129% year to date. We've talked a lot about some of the more recent rockiness. It's down about 16% since its record high back in mid-June. So that's where we are right now. So even with some of the concerns about supply, about delays for Blackwell, that's still where Nvidia stands.
And on Blackwell, latest and greatest generation of chips, said demand strong, he said.
Yeah, he basically said customers need to be doing what they're doing, and so he's confident they're going to keep spending. Let's talk about Petco. That stock is surging after its second quarter results. The pet retailer posting an increase in comparable sales that topped Wall Street's expectations. CEO Joel Anderson also emphasizing a focus on profitability. That is, did I just see you do a double take at how these shares are trading,
Josh Lipton?
Yeah, I had not kept
up on that. What a rocket ship.
Yeah, I of course you know where I always go when I see that. I go to short interest. The short
interest.
What is it? It's not. Well, actually, I lied. It's 30% of float. That is pretty darn high.
Yeah.
So that you're most assuredly seeing something of a short squeeze here.
Analysts weighing in, RBC, saying the pet category far from healthy, Julie, but trends seem to have bottomed, they told clients, and Petco is making notable progress on the cost front. Remains cautiously optimistic that new management will be a catalyst to accelerate cost actions and fine-tune growth initiatives, outperform target 350.
You have a little dog, do you not?
Yeah, very small.
Where do you order your
small old dog?
Where do you order your stuff from?
We actually, it's just a local supermarket move for us.
We do a local place and some Amazon.
Also,
it's a mix.
You're very familiar with my wife, so you're not surprised, but there's a lot of homemade chicken and hamburger going on.
Oh, lucky dog.
It's a very lucky old chihuahua. Taking a look now at shares of Albemarle, that stock seeing a pop after contemporary Amperex Technology, a Chinese battery manufacturer, considers adjusting its lithium production. So this one, a bit in the weeds here, but bear with me, Julie. So basically, it wasn't just this thing. You saw lithium miners making moves today, and it sounds like this is being chalked up to analysts at Citi, who wrote that CATL could be suspending some lithium ore mining and halt some lithium carbonate production. This is per our friend Al Root over at Barron's. And lithium, key material in EV batteries. CATL, by the way, a world's largest maker of EV batteries. So basically, bottom line, there's an oversupply of lithium product right now. It's been pushing down prices. So you get a headline like this, not surprised you see a pop.
Yeah, and UBS has now changed its forecasts in part as a result of what's going on with CATL. UBS is now saying 11% to 23% upside for lithium prices in the rest of this year. So that is quite a change. And it says they have higher conviction related to what's going on in China with that lithium supply. So something to continue to watch here for Albemarle, and there are a bunch of lithium miners around the globe whose shares also rose on this.
All right, moving on. Let's talk about oil prices. Surged today amid worries that Hurricane Francine would disrupt U.S. production in the offshore region for an extended period. Both oil benchmarks had plummeted Tuesday, remember, after OPEC cut its full-year outlook. For the second time with us now is Rob Thummel, Tortoise Senior Portfolio Manager and Managing Director. Rob, always good to see you. So oil did move higher today. I saw, in part at least, Rob, this being chalked up to Hurricane Francine, prompting some short covering. But is that what you saw, Rob? Is that what you think explains the move here?
Yeah, good to see you, Josh. Yeah, partially, probably. I think there's a little bit of production that's been shut in the Gulf of Mexico, probably about 500,000 barrels a day that's been temporarily shut in because of the hurricane, as you highlighted. So that'll take a little supply off the market. But globally, I think, and even domestically, oil is kind of disconnected from the fundamentals. Obviously, there's not a lot of positive sentiment toward oil prices right now, so they just keep dropping every day. The fundamentals, yes, demand's come down a little bit, but still, oil demand is still going to be at least 1 million barrels a day, maybe more than that globally as far as growth is concerned. And it's obviously supply is still constrained with OPEC Plus obviously keeping the supply off the market. So fundamentally, oil looks pretty good, and we'll watch Chinese demand. That's one of the keys. But obviously, the price is experiencing some challenges.
Rob, I have to admit I'm surprised to hear you say this about demand, because I think almost everyone we've had to come on who's commented on oil prices has been, not to say demand is terrible, but they've certainly not been enthusiastic about it. So I'm curious what you see that is encouraging you about demand that the market is missing.
Well, I just think if you look at, if you step back and just look, global energy demand in general is going up. It's going to set new highs this year. It's going to set new highs next year. Yes, Chinese demand is lower, and China is a big driver. They demand a lot of oil. And they consume a lot of oil, one of the largest consumers in the world. So that coming down is concerning, but you still got the U.S. increasing oil consumption. You've got Saudi Arabia increasing oil consumption. You've got other emerging markets around the world beginning to consume more oil. India is consuming more oil. So when you roll all those together, potentially you'll see at least 1 million barrels a day of growth in oil demand globally this year. You're probably going to see more oil demand growth next year. I think what the concern, though, is maybe not as much on the demand side, it's just more on the supply side, because OPEC Plus still has a significant amount of oil that's just waiting to return to the market. And I think that's the concern is there really that demand to really satisfy and absorb that increased oil that's going to come back to the market sometime soon.
Rob, so bottom line, I'm looking at Brent here. We're at 70.52. Where do you see that sort of headed from here, Rob, near intermediate term?
Yeah, I would say I still think that we're going to see in the back half of the year, Chinese demand may be surprised to the upside. It's not going to be what it's been historically, but maybe it's potentially better than what I think, at least the bearish nature around it right now. And so you could have an undersupplied oil market in the second half of the year. So to answer your question, Josh, is I think you could see a $5 to $10 move in Brent prices and see them in the high 70s to low 80s by the end of the year easily, as a result of that better than expected demand that we could see in the second half of the year.
And Rob, all of this, the energy policy, the energy industry in the U.S. came up in the debate last night. I want to play for you a little bit of what the candidates had to say.
My position is that we have got to invest in diverse sources of energy so we reduce our reliance on foreign oil. We have had the largest increase in domestic oil production in history because of an approach that recognizes that we cannot over-rely on foreign oil.
But if she won the election, the day after that election, they'll go back to destroying our country, and oil will be dead, fossil fuel will be dead, we'll go back to windmills, or we'll go back to solar, where they need a whole desert to get some energy to come out.
So it seems like former President Trump has been pretty consistent here, but it does seem like Vice President Harris is coming around more to what our Ben Werschel called an all of the above sort of energy strategy. Is that sort of reassuring for you as an energy investor?
Yeah, no, I think it's a good point, Julie. And Tortoise, we do believe in an all of the above approach to really providing energy supply. Energy demand is just going to go up, and it's going to go up every single year. We're living a little bit, or we're really making history here a little bit in the U.S., as the U.S. being the largest producer of energy in the world, the largest producer or the largest exporter of energy in the world. This is really significant. But if you think about the benefit that the U.S. has, is the U.S. has a lot of low cost, and I would argue low carbon energy. Some of that's natural, a lot of that's actually natural gas. But for economies to grow, you really need energy. So energy is such a foundational element of growing economy. So if we've got low-cost energy in the U.S., not only can we grow our economy, we can accelerate the growth of our economy. That's partially why you're seeing the potential for AI development here, is because of the low-cost energies that's in the U.S. That's partially why we'll have advanced manufacturing come back to the U.S. is because of the low cost of energy. So I think in some ways, both of them are right. We want a lot more energy in the U.S. And also, oh, by the way, the world needs and wants more U.S. energy as well.
Rob, so let's bring it back to investors. They're listening right now. They want to know where to put money to work, Rob. And as you always remind us, not all energy stocks are created equal. So give us some smart places.
Yeah, Josh, and that's really important. So we really like energy infrastructure at Tortoise. It's actually performed really well this year, but it's still trading at discounts to its historical valuation. So companies like Williams, ONEOK, Targa, all in the S&P 500 had great years, but they still have a lot of room to run. They still are trading at discounts to their historical enterprise value to EBITDA metrics, and they're going to grow EBITDA. And they offer investors a relatively high dividend yield, 4 to 5% dividend yield. That dividend yield is going to grow, and we think that that's just attractive for shareholders. Energy Transfer is another one. It offers even a higher dividend yield, probably about an 8% dividend yield. It's going to grow its dividend 3 to 5%. So these energy infrastructure stocks are really companies that generate steady, consistent earnings, don't rely on the commodity price as much, and then they convert those earnings into cash and then turn around and pay that cash back to the shareholder in the form of higher dividends and stock buybacks. And if you can find those type of stocks in an environment where interest rates are coming down, and those stocks aren't overvalued or aren't even at historical valuation, which energy infrastructure is not, we just think that that's a compelling investment opportunity for all investors.
Rob, real quick, I'd be remiss if I didn't ask you about Hurricane Francine and its effect on the Gulf production, and then in turn, what effect we're seeing on oil prices. How do you think about storms these days with regard to how oil trades?
Yeah, that's a good question, Julian. It's always something to keep an eye on. 48% of U.S. refining capacity is on the Gulf Coast. So you say, oh, that's a lot. So should we be concerned that it's coming up the Gulf Coast? Francine is. Well, the good news is it looks like it's going to go a little further east. It looks like it's going to go a little bit more towards Baton Rouge. And there is the first oil refinery ever built by Standard Oil in 1909 is in Baton Rouge. Now, it's obviously been upgraded by Exxon, but it's on path to probably cause that refinery at least to be shut down temporarily, or at least reduce production temporarily. But in general, other refineries are probably not in the path, and so I wouldn't expect much of a disruption to the overall energy sector in general as a result of this particular hurricane. Keep in mind, this is not the first hurricane, obviously, that these energy companies have gone through. They've done a really good job. Management teams have done a really good job of making their assets more hurricane resistant, and so that's really benefiting all of us, because we don't have to worry about these long disruptions that cause significant price hikes during periods of or during the hurricane season itself.
Rob, always great to see you and have you on the show.
Thanks, Josh. Thanks, Julie.
Coming up, the GLP-1 trade lives on. Find out which pharma name JP Morgan believes is well positioned in this space next on Market Domination.
With investors keeping a close eye on the tech trade and rates, we're taking a look at how investors can get a foot in the door through options trading. But which strategy should investors know and use? We'll be breaking down one in particular with Baycrest Managing Director David Boole in this segment sponsored by Tasty Trade. So, David, you are looking at butterfly spread options, that strategy. So first of all, let's just talk in general terms about what a butterfly is, because there are lots of these different methods within options. What is a butterfly?
That's right. It's a combination of calls or puts, one side of the market, and I've seen them used on both sides lately. And it's especially used more when there's a lot more volatility in the market, and options cost more than they have in previous regime. We've all felt that the market's moving up and down over 1% lately, and so traders are getting more creative with the types of option strategies that they put on. So a put butterfly strategy is where you buy the put that you want the exposure to, and then you sell two units of the next lower strike put, and then you cap your downside essentially. So if we want to go through an example.
Well, wait.
Okay.
Hold that thought, because so effectively you're saying the stock is going to fall, but it's only going to fall by so much. You're sort of capping how much downside there is in this example. Is that the right way to describe it?
Exactly. For a small amount of premium, you get exposure to a wide range, and that's why traders really like them. And your risk is limited to the premium that you spend. So if the stock falls by a ton or rises by a ton, you're just risking that small amount of premium. And then you get exposure to that wide range. If you get incredibly lucky and the lottery hits and it settles right at that middle strike, then oftentimes you can get nearly a 10x payout. Most traders go into these trades not expecting to get that 10x payout, but are happy to get 2, 3, 4, 5x. And in the meantime, you have a structure that carries well. It doesn't decay as much as just buying a put outright or buying a call outright. And you get exposure to a wide range to express a view.
And so we're talking to clients, David, and when you're talking to them, give us some ideas. What are you telling them?
Well, right now, everyone's watching, the different economic events, the Fed next week, trying to get a handle of this new volatility regime. In my world, everyone's talking about VIX at 20, which if you zoom into the last 6 months, that's in the 95th percentile. Volatility is high, and traders are feeling that. But if you zoom out, that's still quite normal. The market is moving about 1%. Options are fairly priced. It's just more expensive than it has been. So I'm seeing traders stay nimble intraday with short-dated calls and puts. But then if you're trying to express a view over the next 1 to 1.5 weeks that captures the Fed, many are employing some of these more creative option strategies that reduce the cost of the premium outlay.
All right, so let's get to the TLT put fly short for butterfly in this particular case.
Yes.
So how does it work?
So in this specific example, this is a trade that actually hit the tape yesterday. A trader bought the TLT September 99 strike puts one time, sold 2 of the 97 strike puts, and then bought back the 95 strike put. The 95 strike put is essentially just to cap the downside. If TLT, which is the long bond ETF, falls an incredible amount, you're still capping your downside. You've bought 2 puts and you've sold 2 puts. And in this example, paid about 20 cents for this, and the max profit's in the middle at 97. And if it happens to settle there, which would be incredibly lucky, the trader would make nearly 10 times their money.
Right. So basically, for people who aren't familiar with that sort of payout diagram, we decided that's what we're going to call it. The payout diagram, if it settles around 97, it shows that the peak profit there is just under $2.
Correct.
Right, which, as you said, if you're paying 20 cents, yes, I can do math. Sorry, I'm telling myself that you would get that almost $2.
That's right, and the beauty is the wide range. We're just paying 20 cents for this wide range from nearly 90. You make money 95.20 to 98.80, and so rates have rallied a lot in September. 10 years has moved about 30 basis points, and it's screening overbought on many metrics if you're looking at the bond ETFs, TLT and IEF. So many traders are thinking, wow, this looks like a very quick move. I would like to fade this move, but I'm not sure when the timing is going to happen, if it's going to happen on CPI this morning, or maybe it's going to happen on the Fed next Wednesday. But I just want to play for the TLT to kind of mosey back into this range.
One more, David. I won't surprise you. One name we talk a lot about on the show, Nvidia. What's a smart option strategy there?
So Nvidia had a huge intraday range today from 108 all the way up into 116. And I've the call butterfly, actually the same strategy works on Nvidia. Nvidia's the options are priced high as well, about 50% implied volatility, which implies about a 4% move per day in Nvidia stock. So again, traders are thinking, I think Nvidia, I'm a bull on Nvidia, I think it might go higher, but I think there may be a ceiling. It had trouble getting through the 130 level after earnings, so a trade that could make sense is buying the Nvidia September 120, 125, 130 call butterfly, spending about 50 or 60 cents on that one, and where you could still make this, if you get lucky in the middle, you could make nearly 8, 9, 10 times your money, but instead it's giving you a range from 120 to 130 to play Nvidia moving higher. And that's also where we've seen the flow switch a little bit, where the narrative is clients just buy calls in Nvidia. On the rally, I'm actually seeing more clients sell some puts and sell calls that play Nvidia staying in a range.
David, great to have you here and great ideas. Appreciate it.
Thanks for having me.
All right, let's get to some calls of the day now. Jefferies upgrading Williams-Sonoma from hold to buy, note citing emerging brands and a potential housing recovery in the coming years. Bottom line, Julie, goes like this. They say outsized growth in West Elm Kids, emerging brands and B2B, operating margin, they told their clients, the operating margin path toward high teens from reduced promotions, housing recovery beneficiary, they call out, with 25% of sales tied to existing home sales.
Well, and I thought it was interesting too, because basically the analysts here say that even if the housing recovery is not big, that the gains for the likes of a Williams-Sonoma could be big. So what Jonathan Matuszewski points out in this note, he says even a subdued housing recovery next year could boost comps. He says buyers of new construction spend 5.7 times that of people who aren't moving. So even if anybody moves, if they're spending that much more, it could present some upside for Williams-Sonoma. And by the way, I was looking at some of the recent performance. The stock is up 32% year to date, but they are down 18% from a record high back in mid-July.
Just point out some risks, including things like whether competitor promotions heat up, but clearly on his base case, price target 156.
And let's talk about pharma, too. JP Morgan is initiating coverage on Viking Therapeutics with an overweight rating and an $80 price target. The note highlighting the rise of oral obesity drugs and the potential for Viking's entrant into that market, an oral medication for to fight obesity here. Like Matt Higgins, who we talked to recently for Goodbye or Goodbye, who really likes Viking, the analysts at JP Morgan are highlighting what is called Obesity Week, when a bunch of these companies come out with data. That's November 3rd to 6th as the potential next catalyst, because they're expecting some data maybe to come out.
Exactly right. So he says the phase 1 data for Viking's experimental obesity bill could point to a highly competitive profile and impressive tolerability. He says the oral drugs profile is underappreciated right now. Investors, he pointed out, should be long into the upcoming readout, which he thinks should lead to a substantial up move for shares.
I think it's amazing, these folks who say that the opportunity is underappreciated. Higgins said that too. The stock is up 220% this year. So if there's more,
not all the good news priced in just yet.
That's pretty incredible. We've got some other headlines in the pharma space, specifically regarding obesity drugs as well. Shares of Novo Nordisk and Roche are moving on news about their experimental obesity pills. So this is sort of the next thing everybody's chasing, right? You have injections now. Then they were chasing, do you have to get an injection less often? Now the next big thing is trying to look for pills here. Now Roche came out with some data tied to its experimental pill, but there were some side effects. Novo Nordisk came out with data as well. They had some side effects, but some of the analysts said their side effects weren't as bad as Roche's.
Yeah, we just through reports on Novo Nordisk. So about its weight loss pill, it sounds like it's safe, tolerable were the headlines I saw, Julie, for patients in this early stage trial. Mild to moderate side effects is how I saw it described. Yeah,
but you see those trading in opposite directions. And Eli Lilly was also getting a boost. It's one of those trying to come up with a pill too.
Yep. All right, well, coming up, it's our investor playbook. Got to look at how to position financials in your portfolio. It's coming up next.
It has been a rough start to September for stocks, and with the presidential election getting closer and closer, plus a new batch of economic data this week, the volatility does not seem likely to settle anytime soon. Specifically, we're looking at how to navigate the financial sector with the Yahoo Finance Playbook. Joining us now, Anton Schutz, Menden Capital Senior Portfolio Manager, along with Chris Marinac, Janney Montgomery Scott, Director of Research. And guys, we're also talking about financials because we had the Fed come out with new capital requirements for the banks. And B, we have been watching a financial services conference where some of these banks have been coming out and sort of spooking the market. Anton, I'll get to you first here. Do you think, when you hear the likes of a JP Morgan say the street's estimates for net interest income are too high, how much does that worry you about the banks?
It doesn't. I mean, JP Morgan has a unique balance sheet structure. They've benefited a great deal from the Fed hikes. They've done very, very well and continue guiding higher. I almost think that they'll achieve and beat this lower number. I almost have to say sandbagging. They're a great company. They're priced for greatness. So at the end of the day, no surprise they're guiding down. I think they'll beat it.
Chris, I want to bring you in here on that same question because it made a lot of headlines, Chris. JP Morgan exec comes out and says, listen, I think that analysts are just being too rosy here with their projections. When you saw that, Chris, what did you make of that?
Well, some of it has to do with the timing of when interest rate cuts are happening. And right now it hasn't happened yet, number one. And I think also there's going to be limited margin improvement and limited balance sheet growth for them. So to some extent, it may just be a volume issue that the volume numbers were too high.
And so, Chris, sort of broadening it out then and looking at the rest of the banks, as we're going into a rate cutting cycle, how are they positioned?
Well, the banks are positioned very well because the cost of funds surged during the last 12 to 18 months. And so as interest rates fall, the cost of funds is going to improve. I think there's a lag in how quickly loans are going to reprice downward. So banks should make a little bit more margin. I also think in general, the investors are far more worried about credit quality than they should be. The bank's net charge-offs are very small right now. They're not going to change a whole lot into the next 18 months. So the amount of provision expense and reserve building the banks need to do is pretty limited. So I think there's actually opportunity for banks to make more money based on credit actually being much more stable. And then you also have the idea that I think the banks are set up well for a positive mark from their unrealized securities losses. It's going to be pretty powerful. We think book value may grow as much as 7 to 8% at certain companies this quarter alone.
Anton, I want to bring you here on that same issue, credit quality. We did hear some talk this week. I think it was Ally Financial, Anton, speaking at the Barclays conference, certainly made some comments and maybe spooked some folks. But your thoughts on that dynamic?
Well, I mean, it's really subprime consumer. At the end of the day, they've run out of excess savings. Obviously jobs are no longer easy to find out in the workplace. So, Ally's just seeing the pressure they have from the customer base they have. Most, community and regional banks do not, have those customers. So, very, very different. And here's a point I really want to make. I think this is critical. There's been a lot of people out in major media talking about thousands of banks failing from commercial real estate. The question is, how many have actually failed? Yep, the silence is the answer. It's zero. It is actually zero. So Chris's point on credit quality is critical. And his point on the book values going up is also critical for M&A. Because of the way accounting works, very difficult to do M&A when banks have losses on their books because of higher rates on either loans or their securities. With those losses turning into less losses or potential gains, M&A math becomes much more compelling. And if you look at the smaller banks, they trade at a massive discount to the banks just above them, which allows for very, very easy math to make accretive transactions happen for the buyers. So I expect M&A to pick up meaningfully.
Anton, to be fair, we have been talking a lot less about the risks for commercial real estate for the banks.
You've got it right.
Chris, what do you think about what Anton is saying about M&A? And if you think he's right, where do you think we could potentially see some consolidation?
Well, we're going to see consolidation in a lot of mid-cap banks where, they are sort of feeders for regional banks who want to get bigger. Regional banks that are near $100 billion or even higher, they're going to be making acquisitions to kind of strengthen some of their footprint. We have companies like Huntington Bank who are moving to the south to open branches. They'll eventually make an acquisition. They're naming a stadium in Cleveland, not just for that region, but really to kind of think about more broadly. I think all of the companies are going to find ways to get more scale. There are a lot of mid-sized banks who would like to become closer to 80 or 90 billion dollars, and they'll do acquisitions to get there. So we absolutely are at an inflection point on M&A. Anton is 1,000% correct. The question is how much happens now and how much happens in the next 6 months. The next 6 months is probably more powerful, and the stocks haven't yet discounted that positive news. That's where the opportunity is for investors today.
Anton, you've been doing this a long time. I think it's safe to say there's probably not much left, Anton, you haven't seen in this space. Let's end here. Give me some picks, Anton, some names you like.
Sure. I mean, I'll go to Florida. I'll talk about Amerant Bank. It's on sale below tangible book value. U.S. Century Bank has done really, really well, and it's one of the last banks of $2 billion of size in that market. I look bigger, First Horizon, Tennessee. And then I look in Texas, companies like Veritex.
There seems to be a theme here, Anton. You're looking south.
I'm looking south. I'm looking where there's growth. People are migrating south. Companies are migrating south. Those 3 states don't have any state income tax. It's one of the reasons people are moving. Pro-business governments. So even if the economy slows down nationally, those states are going to have better growth than we're going to see in the rest of the country.
And Chris, real quick, give us your top picks also.
Sure, I like Ameris Bank, ABCB. I like FBK, First Bank in Nashville as well, another Tennessee name. Ocean First in New Jersey, OCFC. And then Wintrust in Chicago, an excellent company, WTFC. If you have to look at a large cap name, Wintrust, besides Wintrust, Fifth Third FITB is my favorite regional bank.
Wow, that was a good lightning round.
It really was. Anton, Chris, great discussion, great picks. Thank you, gentlemen.
Our
Great pleasure.
And we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. Our Alexander Canal is joining us today to recap the trading day, but let's start with where the major averages ended the session, all three in the green, a very far cry from where we were this morning, where we saw stocks fall out of the gate, reaching the lows of the day just after 10 a.m. and then clawing back from there. The Dow, the slowest of the three to reach the green, up 154 points, or about almost 0.4%. The S&P 500 up 1%. It sort of crossed over a little bit earlier in the day, but we saw the shape of all three averages the same here. After CPI, which came in pretty much in line with estimates, but core CPI a little hotter than had been estimating, leading traders to say, well, the Fed is most likely to go a 0.25 percentage point cut next Wednesday. And so all of that initially disappointing, but then stocks coming back. But it was really tech that led the stocks out of that slump here. 2.2%, the final tally for the Nasdaq when all was said and done. Now, Alexander Canal has got a closer look at today's action. Hey, Ali.
Hi, Julian. You said it. The tech rally is back. Tech far and away the best performing sector here, closing up more than 3%. And if we take a look at the intraday rise, at one point we were in the red, but then we saw tech make its way steadily in the green. And that followed comments made by Nvidia CEO Jensen Huang. Nvidia CEO Jensen Huang, he spoke about how generative AI has the potential to go beyond just data centers. That really helped ease a lot of those investor concerns when it comes to a potential demand slowdown. And that really helped lead all of tech higher. You're seeing Nvidia shares close up more than 8%. AMD, another chip stock, closing up more than 5%. We typically see these chip stocks move in tandem with one another. And then some other Mag 7 names, Apple, Amazon, Google, Meta, all closing up more than 1%. Amazon there closing up nearly 3%. Now, moving ahead of today, the focus is all going to be on the Federal Reserve, what they decide to do when it comes to interest rates. The market is currently pricing in a 25 basis point cut next week. If we see anything other than that, I do expect some volatility, but today at least, it's all about that tech trade. Julie, Josh?
All right. Thank you, Ali. Pretty wild day, as Ali was just mentioned there on Wall Street. Major indices climbing from the lows of the day, managing to post gains across the board. Nasdaq leading the way and bringing up the rest of the market along with it. Joining us now is B. Riley Wealth Chief Market Strategist Art Hogan. Art, always great to see you. So let's talk about this market. Art, this morning, get the CPI print. We did see, a slide there late morning, but then here comes Nvidia. Art surging 8%, leading us back. What do you make of today's trade?
Yeah, interesting day, right? So, the day is sort of like the week has been, right? So the first time that I can remember, we've seen an S&P 500 lose and gain 100 points in a single week. And that's very typical of September. I think the reaction to the CPI likely was an overreaction. And then we started getting comments from a multitude of conferences that are going on September's conference season. So it doesn't take much for Nvidia to get people excited about AI again, especially with the selling pressure that the group has seen over the course of the last 2 months. So a nice rebound there that took the rest of the technology group up with it, especially the AI adjacent names. But I think that when you take a step back and say, if our biggest concern is that today's modestly hotter core CPI number means the Fed's going to go 25 basis points versus 50, that was consensus coming into the day, right? So it just went from 70% to 85% consensus. So I think just a major overreaction in what has become an oversold September tape, and I think that the rally in the afternoon probably makes a whole lot more sense.
What about, I want to drill down on Nvidia and the tech reaction a little bit, Art, and by the way, it's great to see you. So Jensen Huang, from what I read at the conference where he made comments, he didn't say anything that crazy. He mostly reiterated that demand has been strong, and there really hasn't been anything to challenge that demand has been strong. Were people just looking for an excuse to get back in here on Nvidia and some of the other big tech companies?
Yeah, so the semiconductors in general, down some 23% coming into the morning already, right? In the current sell-off in both, August and thus far in September. So you've got an oversold group. It doesn't take much of a push to get investors back in excited about a group that was trading significantly higher than this just 2 months ago. To the extent that his commentary was revelatory. It was much more about, hey, it's not just about data center. There are going to be other applications for artificial intelligence where you're looking at the tip of the iceberg. But to your point, what we already know is all the hyperscalers have reported and talked about their ongoing CapEx, where 80 to 90% of that's going to Nvidia. So clearly, oversold stock, oversold group. Calming commentary from the guy that runs the place, and it didn't take much to sort of start that fire.
Art, with the S&P 500 here at 55, 54, your year-end target, Art, is what?
5,700, and that's based on a assumption that we're going to see about $260 in earnings. Consensus is about 254 right now, and I think that with the beat ratio that we've seen for the first 2 quarters and the cadence of earnings for the second 2 quarters of this year, probably an attainable goal. Just put a trailing multiple on that, and you get to 5,700, or you could take a 12-month, next 12-month multiple on that, and get to the same place. But I think it's obviously it's been a bumpy road getting there, and clearly that looked a lot braver in January when that came out than it does today, because it's not significant upside. But I clearly think the path of least resistance for this market continues to be higher. If you look at earnings estimates for the next 2 quarters, they're low double digits, and we typically are conservative with those, so we'll likely do better than that. GDP's tracking at 2.5% according to the Atlanta Fed, and we had a 3% GDP growth rate in the last quarter. So while the economy's slowing a bit, we're still seeing an economy that's growing above trend and driving earnings growth. So that that's kind of where we get to that year-end target and what the drivers are.
You mean you haven't changed the target 15 times since the start of the year, Art? No, I
just
kid,
said that was way too brave at the beginning, and I think people thought were looking at me like I had antlers or something. But
it's nice when it turns out. Although knock on wood, we still got a few months to go. But Art, do you think that to go back to technology, is that the best way to play it right now, or would you be looking to add elsewhere?
That's such a great question. When you look at the cadence of earnings going forward, the biggest part of that earnings growth is actually coming away from technology. So for the first time in this cycle, we're actually going to see the participation of the other 493 stocks in the S&P 500 actually grow their earnings at a faster pace than we've seen for the last year and a half. So I'm excited about technology and always will be. It's always going to be a core investment, but we'd also like to broaden that out as the market broadens out and look at some of the sectors that have underperformed, because I clearly think the earnings potential for the sectors other than tech and communication services is pretty exciting in the back half of this year and the first half of next.
How about small caps, Art? Do I want to own those?
You do. Interest rates are going down. The 2 things small caps need is an interest rate environment that's coming down. They're more dependent on interest rates as they're more dependent on debt. So as that comes down, that's a headwind that's turning into a tailwind right in front of us, and I think that continues well into next year. The other piece is you need sustained economic growth for the small caps, and clearly running at a north of mean 2.5% to 3% GDP growth rate this year is going to be another positive. The only reason they underperformed last year was clearly interest rates weren't coming down while we did have robust economic growth, but we're switching that around, and we're going to turn 2 headwinds into tailwinds for the small caps, and this is the environment they tend to do well. The other piece of the puzzle, Josh, is that they clearly, the mean reversion they have is as wide as we've seen between small and large, going all the way back to 2000. So that tends to rectify itself, especially when you get a couple of catalysts like falling interest rates and steady economic growth.
And Art, finally, to close it out, I want to broaden it back out and go back to that 5,700, because a political question about that. Does 5,700 stand no matter who wins the presidential election?
Yeah, we love to talk about the presidential election and then try to make comparisons to what that might mean for markets. But at the end of the day, history will teach us that the best market we could have would be, agnostic of who's in the White House, a divided Congress, right? And that tends to be how markets do their best. If you go back, since 1950, it's always been, whether it's a Democrat or Republican in the White House, as long as they don't control Congress, markets tend to do great. And regardless of what polling you're looking at, it doesn't look like either side is going to run the table here.
All right, good to see you. Thanks a lot for joining us.
Thank you.
You're watching Market Domination Overtime, sponsored by Tasty Trade. And coming up, a look at the private market with Joan Solotar, Blackstone's global head of private wealth solutions. That's next. August to September has been a whirlwind for equity stocks in a tug of war to hold on to gains as investors examine the health of the economy. All while, according to BlackRock, advisors are increasingly turning to private markets for diversification. And it's a big opportunity with 90% of companies with revenues of over $250 million being private. Here to discuss is Joan Solotar, Blackstone's Global Head of Private Wealth Solutions. Joan, it's good to see you. Thanks for coming back in to see us.
Thanks for having me.
Now, here in Yahoo Finance, we talk about public markets all the time, but private markets are huge. And increasingly, individuals have more ways to invest in the private markets, which is where you guys come in.
Yes.
So what kind of flows, what kind of demand are you seeing, and from whom right now?
It's a great question. It's really everywhere in the world that I travel. Advisors are looking to put more private investments in client portfolios. And just this year alone, first half of this year, we raised as much in the open-end private funds as we did all of last year. So definitely seeing demand on the rise.
What do you think is driving that?
I think it's a combination of what private markets offer. And you mentioned it's the biggest part of the investing pool. So if you think about, 90% of scaled companies, 90% of commercial real estate actually resides in the public market, in the private markets rather. And so if you're only investing in that 10%, you're really missing just a world of opportunity, number one. But what do private investments provide? Depending on the asset class, could be enhanced yield, higher return, coupled with lower volatility. And I think most importantly, they're important diversifiers with a stock and bond portfolio.
And you guys have been pretty aggressive this year. I know early on you said inflation's going to moderate. I don't mean you specifically, but as a firm,
yes.
Inflation's going to moderate, rates are going to start to come down. We want to put money to work.
Correct.
And as a result, you all have been investing in real estate, you've been investing in private equity. What is sort of the big bet now going forward?
So I'd say we are very sector focused. So you mentioned real estate, and it's so interesting because we had in the real estate markets 2 years of pretty negative performance out there. And in January, we indicated we saw a flattening in most sectors, the sectors that we're interested in, and that's proven to be true. And when you think about interest rates coming down and trends improving, it's created an environment that's much more animated. So even when we're selling properties, whether it's rental housing or logistics, we're actually seeing 3 times the number of bidders than we were a year ago. So we like sectors, for example, in real estate that center on where you have greater demand than supply, not surprisingly. So areas like logistics, where you have companies such as Walmart saying, we're going to deliver in a 2-hour window, so they need to be close. We like rental housing, where this year you've seen some supply come on because of a lag from COVID. But when you look at housing starts, they're at the same level that they were 10 years ago, but we have twice as many people living in the country, right? So huge shortage there. And also student housing, very similar dynamics. And of course, data centers.
I was going to say, you saved the biggest for last.
I know, of course.
I mean, that has been a huge bet on the part of Blackstone. We talk about data centers a lot. We talk about Nvidia a lot. We talk about the hyperscalers a lot. Do you expect to continue to see the kind of growth that we have been seeing?
Oh, yeah. This is so early. I was with Steve Schwarzman last week, and he said, think about when the light bulb was invented, and we couldn't imagine what was going to happen with electricity. And that's how I think you have to think about AI. So the hyperscalers are investing an awful lot of capital. I think it's something like $1 trillion. So the demand for scale data centers with connectivity to energy and with the proper equipment, it's just enormous, and you need billions of dollars to build these things. There's just not enough capital and not enough, today, connectivity to energy. So investing in data centers, investing in energy, all the picks and shovels around that, not just in the US. I mean, we just actually announced that we're going to be buying a company that's Asia-based, also data centers. It's the biggest investment in data centers in the world, and not just for us, just ever. So I think this is not dissimilar to how we thought about e-commerce more than 10 years ago. This is a very long-term trend, secular trend with a lot of tailwinds.
And just quickly, you and I have talked a little bit about public market valuations versus private market valuations, because there have been some questions, perhaps less so in real estate, but definitely in private equity. For example, in venture, there was just a story that crossed about OpenAI raising another huge amount of money. What do you make of those valuations, and what is the risk of overpaying for things in the private market?
Yeah, I think it's a fair question, and what we know and what we're more familiar with are public markets, right? And they move. And on your show, you were talking about it just earlier. We started down on the day and we ended up on the day. But in the private market universe, and we're the biggest investors in real estate, we have the biggest and broadest private equity platform, so we're seeing a lot. You really get to assess what true values are, what you think you can do to those assets to make them better and create value. So it's not just the price that you're paying. But they're de facto going to be more stable because they're not subject to the daily whims of the market, number one, and they will trade at a net asset value, if you will, rather than extreme premiums or below that, of course, discounts in any one day. So I do use real estate as the great example because it brings it home for people. The building across the street, it's just not moving in value by 10 or 20% in a day, but you can see individual stocks moving by that. So it doesn't often reflect what's actually happening on the ground.
Makes sense. Joan, thanks for coming in. It's great to see you.
Thank you.
Appreciate it. Josh?
After 155 years, Campbell's Soup Company is changing its name, dropping the food that made it a household name in the first place. For more on how the company came to this decision and why is Yahoo Finance's Brooke DePalma no more soup.
No, there's still going to be soup
there
in the
is soup.
portfolio.
Okay.
Absolutely.
Not in the name,
Okay.
but in the portfolio.
But in the portfolio, exactly, Julie. There's goldfish, there's Pepperidge Farm, there's potato chips, there's sauce, and there is still soup. But pending shareholder approval in November, Campbell's is looking to change its name from Campbell's Soup Company to the Campbell's Company to really reflect the current portfolio of today. Mark Klaus telling Yahoo Finance that he wants to be sure to strike the right balance because he said, we do love soup. It is foundational to us as a company and it's a critical business and they're not taking their eye off that ball. But he does think that it's fair to say that today's portfolio is different. Now, the company does expect organic net sales to grow between 2 and 3%. They do expect snacks to grow consistent with how it has been historically between 3 to 4%. Meals and beverages business between 1 to 2%. They do project soup to remain flat, though, in terms of long-term sales growth. Now, one analyst I spoke to isn't too worried about that. They said that Campbell's Soup Company, or what could be known as the Campbell's Company, will still invest in soup in order for that to remain flat, but they expect other brands like Rao's or the snack business to really deliver growth there.
Well, and speaking of Rao's, you talked to the CEO about that and sort of, what potential things that they've learned from that acquisition.
Yeah, $2.7 billion. It was one of the CEO, Mark Klaus's, really, if not the first acquisition that he's made in the last 5 years of his tenure. And it really speaks volumes to the ability of Rao's to cater to different income cohorts at this premium price point. He said that they learned that consumers are willing to splurge for that $8 to $9 sauce over, say, going to dine out. In addition to that, he also learned that multiple price points can still exist within the same portfolio. You have a Rao's that's, like I said, $8 to $9. They're even looking at a, say, $12 to $14 limited batch option for Rao's. But then you also have Prego, which is a $4 price point. And lastly, this could be a future indicator. Campbell's Soup Company Campbell's company, has no eye on potential targets, but what they learned here is that there really is this optionality. It could open the door to other cuisines, say other premium Mexican sauces, or as the population of the US really changes, he's saying, what is the next Asian or Hispanic option like Arroyo's is?
Is sauce a kind of soup? No, I'm just kidding.
They don't have a soup option, but...
There you go. All right, thanks, Brooke. Appreciate it. Well, sticking with the food space, we've got a preview of our latest episode of Lead This Way. Brad Smith sat down with the CEO of Smucker, Mark Smucker, about running his family's 127-year-old business. Here's a preview.
Ever feel pressure as the person who's essentially carrying the torch now as part of the family to not mess up?
I've made a lot of mistakes, and there's things that no one can teach you. How to manage an A team, how to make sure that, again, I'm open to divergent points of view, but trying to recognize the moments when I have to make the call. The one adage that you hear all the time is surround yourself with people that are smarter than you. That is 100% true. Everybody on my leadership team is smarter than me. They know things that I don't know. They all come from a different place with different expertise, and they all see the world differently. And so that diversity of thought creates an outstanding environment where we get much more out of each other because we're offering different points of view.
The full episode airs tomorrow at 11:30 a.m. Eastern. Asking for a Trend is next.
Hello and welcome to Ask for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Bouncing back, stocks closed near the highs of the session after this morning's CPI print initially rattled investors. Tech stocks leading gains thanks to Nvidia. Today's move was the biggest comeback for the S&P 500 since November 2022. With CPI in the rearview mirror now, the focus shifts to the Federal Reserve. We're a week away from the Fed's likely first rate cut, and markets pricing in a 25 basis point move. Plus, markets eyeing fiscal policy on the heels of the first presidential debate between Vice President Kamala Harris and former President Trump, taking a closer look at the economic implications of the policy proposals from both those candidates. S&P 500, Nasdaq surging in today's trade. Stocks reversing those earlier losses as investors weigh the latest inflation data. Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Josh.
Hey Josh, it was all about tech today in the stock market. So let's take a closer look at this tech rally that we had. I'm going to start with the sector action, and you can see tech was the only sector that outperformed the S&P 500. That's up in the top left there. XLK rising more than 3%, outpacing the S&P 500's 1% gain, and really the only sector that just felt like it took off. So you can see it took off really in the middle of the day here when we look at this intraday. This is right around when Nvidia CEO Jensen Huang was speaking at a Goldman Sachs conference, and you take a look at Nvidia stock itself, which was up over 8%. And it seems like what Huang had to say about demand, of course, he often talks about the fact that they have essentially more demand than they can meet, right? But it seemed like maybe him coming out today might have eased some investor concerns. You and I have been talking a lot about, okay, what's the catalyst for these tech stocks, right? Now that we're through earnings, what's it going to be that can help them? It seems like Jensen coming out and speaking today and sort of speaking about the overall demand in that industry and where they sit, at least for today, helped Nvidia, and that helped the overall market.
Yeah, Jensen comes out and says demand for Blackwell, so the latest and greatest current generation of chips. He said, listen, strong demand, you know. And also, I mean, so what did the SMH do today, Josh? Did we see the pop there?
I'm
putting
not
you on the
sure.
spot. That's not fair.
I'm not
but
sure.
We did talk to a strategist today who said, listen, not to take anything away from Jensen Huang, what he said, but he said, looking at a lot of these names, of course, they've also been beaten up. They were ripe for a pop.
Absolutely. I mean, you look, I pulled up semis for us here, and if you look over the last 10 days, it had not been pretty for some of these stocks. You zoom out even further over the last 2 months, it has not been pretty for some of these stocks. So perhaps it makes sense for people to pile in a little bit there. But the real story of the day that was driving the markets in the morning was the CPI print that we had, right? And sort of the takeaway from that being, seems like we're going 25 basis points, not 50 in September. That had been sort of the hot debate over the last month, right? So what I pulled up for us here, this is that CME Fed watch tool that we talk about all the times, and the percent chance that markets are pricing in, right, for a 50% cut. A month ago it was 51%. We were looking at 50-50 split. Then you get to 44% just last week after that last jobs report. Then today you're down to 13%. Economists essentially reasoning that because core CPI increased 0.03% month over month compared to the 0.2% we have been seeing, not quite enough to convince the Fed that they should be overly confident in where inflation's headed to do 50 bips. So it feels like maybe we're settled on this one, at least for now.
It was interesting, Josh, because you saw the CPI print, you know, it hits, and initially you saw that slide, and I don't know, was that, we were talking about this, where that the pickup in the core index, whether at least late morning investors were sort of like, well, it's not going to change whether Jay Powell cuts next week, but maybe this talk of a supersized cut that was in the bloodstream, that dimmed. And we did slide, but as you know, tech led us back.
Right, and really what we were looking at too at that point too, I'll go back to our sectors for a second and just point out some of the action that we saw throughout the day. You saw a little bit of recovery, but overall, we were looking at a lot of interest rate sensitive sectors, and those are still some of the ones that ended up finishing in the red here. I'm looking at real estate. They were the laggards in the morning. They came back a little bit, and I think part of that maybe has to do with part 3 here that we're going to point out. All eyes go to the dot plot and whether or not we are going to get, this is where markets have thinking we're headed, right? This is over the last month, all those forecasts I've been talking about, the destination is still 4 cuts, but there's an underlying theory here. Eric Wallison over at Yardeni Research highlighted this morning to our morning show, saying if the Fed doesn't go 100 in 2024, maybe it's because things are good, right? Maybe they don't go 100 because the economy is strong, and maybe that's good for earnings and is actually a good backdrop. I think we're going to start hearing a little bit more of that rhetoric as we go toward next week and moving forward.
Is that Yardeni's new lieutenant? That's a new name.
New lieutenant. Ed Yardeni's got another guy over there.
You're one on the Yardeni team. Interesting. Thank you, Josh. Appreciate it. Moving on, the presidential debate Tuesday night covered a wide range of topics concerning everyday Americans, including inflation, healthcare, immigration, and of course, the economy. Take a look.
The best economists in our country, if not the world, have reviewed our relative plans for the future of America. What Goldman Sachs has said is that Donald Trump's plan would make the economy worse, mine would strengthen the economy. What the Wharton School has said is Donald Trump's plan would actually explode the deficit.
I went to the Wharton School of Finance, and many of those professors, the top professors, think my plan is a brilliant plan. It's a great plan. It's a plan that's going to bring up our worth, our value as a country.
Joining us now with more on last night's debate and the state of the race is Neil Irwin, Axios chief economic correspondent. Neil, always great to see you. So let's get right to that debate. Neil, Trump and Harris. I'm just curious, as you were watching it through your lens, Neil, as an economic correspondent, what did you make of it? What did you learn?
So no huge surprises in terms of the overall themes that the two candidates were embracing. I think it was notable that Vice President Harris emphasized some of this research that's out, suggesting that a Trump agenda would mean higher inflation, would mean lower GDP growth. She cited that Goldman Sachs report. She cited the Penn-Wharton budget model that's on the fiscal effects, the deficit effects of Trump's agenda. The fault lines are kind of the same as they have been for quite a while, even though Harris has changed a little bit from some of Biden's preferred economic policies on taxes. The changes aren't huge. So, this is basically the similar kind of economic agenda we saw from President Biden over the last several years. And Trump is Trump. He wants to do a lot of tariffs. He wants to move fast and break things. And, a lot of the mainstream economists think those things would break the economic growth that we've been seeing.
Neil, do you think now that we as voters, as investors, do you think we have enough details at this point from these candidates to make good informed decisions about, their competing economic agendas and visions?
I think so. Look, the Trump campaign is not the kind of thing that releases a 30-page white paper on the details of their tax policy. But directionally, we kind of know what he wants to do. We know that he wants to extend and maybe go further on corporate income tax rate cuts. We know he wants to extend his tax cuts that were passed in 2017 or set to expire at the end of next year. We know that he wants to do a bunch more tariffs, to slap tariffs on a lot more goods that should raise import prices, could contribute to inflation, and disrupt global trade patterns. And we know that Harris wants to mostly keep those tax cuts for middle and lower income people under $400,000, but does want to raise taxes on capital gains, on corporations and the very rich.
Fine, get you on this, Neil. Just switching gears a bit, we did get that CPI report this morning. Pick up in the core index. Interested what you made of that report, Neil, and where you see inflation headed from here.
Yeah, I think it's a good reminder that the inflation conversation is not completely over. Just because we're kind of trending toward 2%, the trends have been good the last few months. That doesn't mean this thing's all over. That said, the rise in core inflation, core CPI, was driven by housing costs. And we've been waiting for this for a year and a half now, but we're still waiting to see some of this disinflation in rents that we've seen in private indicators show up in the official CPI data. Didn't happen in August. It may still be on the way. That should give a little relief to the Fed as they decide how much to react to this kind of just continued warmth in the inflation data. Also, I'd add, even when you include housing, core CPI last 3 months only a 2.1% annual rate. That's nothing to be alarmed about. That's bang on the target.
Neil, we're always lucky to have you on the show. Thanks for joining us.
Thank you.
EV maker Lucid revealing new information about its upcoming full-size Gravity SUV. And for more, we're bringing in Yahoo Finance's senior autos reporter, Pras Subramanian.
Yeah, so Lucid had a manufacturing technology day at its factory, and it seems like Wall Street's liking what they saw. A couple of things to go over first. You mentioned that Gravity SUV. It's on track for later this year production. People are excited about that. They also they're going to add the Tesla NACS port. So basically have native access to Tesla's supercharger network. That's a nice boon for that vehicle. But also they talked about a deep dive into their technology and how Lucid says that we're actually pretty cost competitive when it comes to our powertrain, meaning the battery and electric drive units and stuff like that. They showed some numbers that an independent third party kind of put together, showing that they were pretty competitive in terms of price, in terms of cost, but also better in terms of functionality and performance. But the proof is in the pudding. The car still costs a lot of money to make.
How much are we talking about? Do they give a price for this new Gravity SUV?
So this new car is going to start around $80,000, which is the threshold for the federal tax credit. The problem is right now is last quarter, Lucid lost around $300,000 per car they made, right? So it's a scale issue. And that's what Wall Street's talking about. So Bank of America had a note come out this morning talking about how very positive on the technology front, but also that this is a scale play. Once this Gravity comes out and the mid-size car in 2026, they'll build up that scale so they're able to kind of amortize that cost and use the technology they have that's kind of world-class technology that actually they can make that stuff cheaper than Tesla, for instance. That's something to be spread up across a number of vehicles, and that's the positive effect. They think that's going to be the future potentially for Lucid.
The stocks, I mean, it's rough, right? I mean, year to date, over the past 12 months, I know this is purely anecdotal, but deep in the suburbs of New Jersey where I live, I see more Lucids.
Yeah, anecdotally, let's chat, right? I've been seeing way more Lucids too. And I think there's going to be a lot of demand. I mean, the CEO thinks there's going to be a 30x sort of market for the SUV versus the regular sedan, right? So you might see more and more of these SUVs, especially at $80,000. I think that's a fair price for a luxury SUV that, people pay that all the time, right? In places like New Jersey. Right?
Yeah. It's a slick looking car.
Yeah, I think
nice lines.
And I saw the SUV in person at Pebble Beach, and I thought it looked great. Huge, but also not huge, but it had a lot of interior space because of the way that the skateboard-like platform of the EV kind of is. You can fit a lot of people, a lot of things in there. I think it's a pretty nice looking car. Should play well in the coasts, I believe.
All right, Praz, thank you, my friend. Appreciate it. Coming up, an interview with Okta CEO Todd McKinnon. Stay tuned. More Ask for a Trend on the other side.
All right, Yahoo Finance is continuing its coverage at the Goldman Sachs Communicopia Conference. A lot to say, but a really interesting conference here in San Francisco as always. Let's stay on all things interesting. Okta co-founder and CEO Todd McKinnon is here. Todd, good to see you. Feels like we were just here 1 year ago.
It's great to be here again.
So talk to us about the state of your business. We've talked to a lot of people on the ground here, how the macro environment has slowed down, has impacted on what they're buying, what they may not be buying. I mean, how do you see it from Okta's vantage point?
Well, identity is as important as ever when you think about companies, particularly trying to be secure. When you look at security breaches, everyone's familiar with the headlines and everyone has received the notifications in the mail about their personal data was compromised somewhere. 85% of those breaches are related to identity. So there's a stolen account, someone gets phished, an administrator account gets taken over. And so when we talk to customers, they want to be more secure, and we can help them do that by providing the best set of identity products across all of the identity categories. So that's good. I think what's different is that companies are being careful with their money. They're rationalizing the technology they purchased over the last 4 or 5 years. They're making sure that they're getting real ROI out of all the solutions. So it does take longer sometimes to justify what they're investing in, but we're very confident in our ability to do that over time, and that's what we're focused on.
Isn't that, to me, that comes as a surprise. I mean, I view what Okta does, and I'm just going to say it's not because you're sitting here. I mean, it's almost an essential service in this environment where hackers are doing God knows what beneath the surface. I mean, does that surprise you, to hear that people are rationalizing this type of service?
Well, the environment these companies are operating in, their technology environment, is very complex, especially if you're any size company. You're going to have thousands and thousands of technology vendors, and you're going to have legacy technology, and you're going to be thinking about how you migrate to the cloud and how you give your employees the best employee experience. So if you think about it in abstract, yeah, it's like, why wouldn't you want to secure your identity? Why wouldn't you have the best identity technology? That's true. But when you think about some of the complexities these companies have to manage through, they have to think about when they're going to retire old systems and how fast they migrate to the modern things and where they're putting their dollars in terms of security, but also business moving forward initiatives like building new websites and mobile apps, and how do they incorporate AI into that. So it's quite complicated. So if we can work with them a little more to justify the value and get them comfortable, we're happy to do that.
A lot of companies, are they still behind in upgrading their technology in the context of just how fast AI is moving and spreading inside of organizations?
AI is definitely a firestorm in terms of innovation and people worrying about being disrupted and being excited about opportunities that they can take advantage of. The same thing for Okta. We're thinking about how we use AI in our platform. It's called Okta AI, and we're incorporating that into all of our products, and we have new products that it makes possible. And customers are doing the same thing. They're thinking about how they can build new websites and mobile apps and what their competitors are doing and how fast they can lower costs and drive revenue. Now, what that really forces a lot of them to do is really further the acceleration to more modern platforms like Okta Identity or AWS for Cloud, because one thing about AI, you're not going to get that in a legacy data center. You're not going to get that in you're going to have to modern SaaS applications to get AI. You're not going to get it in legacy on-premise applications. So, and that's been a driver for our business in the macro, just in terms of like technology transformation, and AI directly affects our business, but also just makes this impetus to upgrade and modernize and transform even more for companies.
From the outside looking in, I'll consider myself on the outside and looking in, AI seems to be moving very fast. Technology, the adoption, how people are using it, embracing it. What does this mean for our identities? Is our identities going to be put more at risk? Are businesses more at risk because of AI?
I think there's opportunity and risk. I think with any wave of technology, you're going to see the bad people going after it in ways to, whether it's deep fakes or whether it's taking advantage of the information that some of these chat models are telling us and responding to our searches and trying to influence that in certain ways, just like every wave of technology, the internet and search engines when they first came along. But there's also capabilities it can add, so it's about the industry, how we balance it out and how we make sure take a look at what the progress is and how we can balance it out with the benefits and the costs and the risks and work through that as an industry.
Does the industry get back to, or does the industry see accelerated growth in 2025?
I think the industry, that's a big question. I think in terms of Okta, we're very focused on reigniting growth. Our growth has, like a lot of companies, our growth has decelerated over the last year or so. And we think because of the trends we talked about, we have an opportunity to re-accelerate growth. So we're doubling down on product innovation. We've recently made generally available great products like identity threat protection with Okta AI, identity security posture management, highly regulated identity. So the foundation of that acceleration is going to be around products, and we're really excited about the product pipeline we're delivering.
I think a lot of folks in your industry are still trying to figure out what happened with CrowdStrike. I think we have an idea on what happened with it. But as a co-founder of a company like Okta, when something like that happens, what do you do? What do you tell your leadership team? Do you go back and check things? Like, where was your head out in that type of moment?
It's, as a co-founder and someone that builds a company, the first thing you have to do is you have to communicate directly and clearly and effectively. And that's to employees, to customers, to the market. And I think you saw CrowdStrike do that, which I give them a lot of credit for that. The second thing you have to do is make sure that you're very clear with everyone, all your constituencies, about what you're going to change and why it happened, and root cause analysis, and being open about how we got in the situation, and what are the trade-offs, because all these things come with trade-offs. You know, the architectures, the approaches. Maybe the trade-off is build the ability to get updates globally to every computer in the world quickly. Maybe that's not something that is advisable. Maybe you should slow that down a little bit so you can test updates globally. Okta has this challenge internally at our company. We release integrations and continuously update them, and over the years we've had to make sure that we balance the need to get those integrations quickly deployed to every customer in the world, balance that with making sure they're tested and reliable. And my point is that when you do things differently, you have to make trade-offs. And maybe the trade-off is, like in our case, we're not going to release those updates as frequently. We're going to test those more, even if the cost is they're not going to get up there as fast. So I expect that the company would rationalize those things and have a great root cause analysis, and also look forward and make real trade-offs to prevent things from happening going forward.
Tom McKinnon, always great to get some time with you. Okta co-founder and CEO. We'll talk to you soon.
Thanks for having me.
All right, much more ahead on Yahoo Finance.
Atlanta Federal Reserve Bank President Raphael Bostic in some hot water again. Yahoo Finance's Jennifer Schonberger joining us now with the details. Jennifer.
Josh, the Federal Reserve's Inspector General found in a report today that Atlanta Fed President Raphael Bostic violated Fed policies governing how officials can trade and invest, but did not trade using confidential FOMC information. Now, while he did not trade using confidential FOMC information, the report reads that, quote, Bostic created the appearance of acting on confidential FOMC information under the FOMC blackout rule, as well as the appearance of a conflict of interest that could cause a reasonable person to question Dr. Bostic's impartiality. The IG, however, noted that they determined that Bostic did not have financial conflicts of interest and independently verified that Bostic relied on third-party managed accounts that neither he nor his personal investment advisors had the ability to direct specific trades. Now, the report lists 4 violations. Among those violations, violating the FOMC blackout rule when securities transactions were executed on his behalf during multiple blackout periods, the failure to properly disclose his securities transactions on proper forms, as well as executing trades that were not in accordance with the pre-clearance system. Federal Reserve Bank of Atlanta Board Chair Claire Lewis Arnold telling Yahoo Finance in a statement that, quote, we take these issues seriously and the full board will meet to carefully discuss the report's details further. Josh, this was initially opened back in October of 2022. This issue is now closed, is not expected to be elevated to the Department of Justice. Back to you.
All right, Jennifer, thank you. Meanwhile, the focus of today's chart of the day, inflation. While the consumer price index is moderating, it's still a focus for consumers and in politics, as evidenced by last night's debate.
Has no plan for you. And when you look at his economic plan, it's all about tax breaks for the richest people. I am offering what I describe as an opportunity economy.
We have inflation like very few people have ever seen before, probably the worst in our nation's history. We were at 21%, but that's being generous because many things are 50, 60, 70, and 80% higher than they were just a few years ago.
And Yahoo Finance's Julie Hyman joins me now with a closer look.
So
Julie.
I wanted to put some context around this inflation discussion that was happening last night at the debate, especially given that we got CPI this morning. Now, first of all, this is not the worst that inflation has ever been. However, that 21% that former President Trump was mentioning has to do with the overall consumer price index, which indeed, if you go all the way back to January of 2020 through last month, was indeed 21%. Now, I don't know if that's the number he was referring to, but that is a number that coincides with 21%. Now, when he was talking about certain individual things that have risen even more, a lot of the discussion and complaints around inflation have had to do with what people are spending at the grocery store. So I decided to take a look at that. Food at home is what the BLS, which tracks the data, calls it. 26% is the figure there over the same period of time. So indeed has outpaced the gains that we saw in overall inflation. Still not 40, 50, 60, 70, 80%. However, if you look at some individual items, you see some pretty eye-popping numbers. Steak, for example, up 42% over this period of time. Eggs, which, as you know, have gotten a lot of attention, have more than doubled in that point in time. By the same token, fresh fruits and veggies up only 17%. So less than the overall pace of inflation. And if you wanted to eat out, it cost you more, 28%. So just a few examples, since all of this discussion about groceries has got me thinking. Now, we asked Jose Torres of Interactive Brokers about the inflation numbers, specifically about groceries, and here's what he had to say.
Well, we have a bifurcated consumer, right? We have one consumer that has investment portfolios, has a couple of real estate properties. They're doing great. But the consumer that's focused more on labor income, right? Those income gains haven't really been proportionate to the gains in prices. So they've felt somewhat of a squeeze. And then also there's sticker shock, right? Us on Wall Street, yeah, sure, we see 2.5% inflation. We cheer, but other folks, they remember a bag of chips when it used to cost a quarter. Right? So that's kind of sticker shock also, does, weigh on overall consumer sentiment.
Yeah, so these numbers definitely play a role in consumer psyche, Josh.
For sure. Julie, thank you. And time now for What to Watch Thursday, September 12th. Starting off on the earnings front, we're going to be getting another batch of earnings tomorrow. That includes Adobe, Kroger, and RH. Adobe reporting third quarter results after the close. Investors listening for any new details about its Firefly text-to-video AI tools that it teased earlier today. And taking a look at the economy, a new PPI print for August. That's the Producer Price Index coming out ahead of the open. Economists forecasting core PPI to rise 0.2%, while overall PPI holds steady at 0.1%. And weekly initial jobless claims data also due. The number expected to tick down to 226,000 in the most recent week. And moving over to housing, we're going to be getting new mortgage rate data from Freddie Mac. 30-year fixed rate mortgage coming in at 6.35% in the prior week. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.